As being the macro man, Julian McCree. Julian, what can you tell us about macro markets today?
Yeah, hi Paul, and happy Easter to everybody wherever you are in the world. It's been a wonderful day here in New Zealand, and a wonderful Easter weekend, which is quite unusual. So often we get, as the turn of the season's a bit dodgy weather, but this time it's been amazing. So yeah, look, Paul, I think from my perspective, this is a week of, as usual, when we have a couple of extra days, a week of thoughtfulness, and also trying to do a little background work into the medium term and the long term. So. I was just sharing with this with a few people just a couple of minutes ago, Paul. I think it's okay to put my cycle chart up there, isn't it?
Yes.
Let me just see how I can do that. So please. Oh, I don't think I've got. Yes, I do. I should be okay to do screen sharing. So just hold on a second while we do some of this. Just hold on, everybody. I apologize for this. It's not normally as broken up as this. Hopefully you can see this when it comes up on the screen. If it doesn't, I'll just share again. And here we go. Okay, so there's this is the medium and short-term cycles of the US stock market. So food for thought more than anything else. Okay, when I talk about cycles, I don't mean to call market tops and market bottoms. That's all very interesting. If it coincides, that's brilliant. What we're really trying to show here is these are turning points. They're turning points, but not the magnitude of the turning points. It's entirely feasible the US stock market goes sideways here. But I think for the next couple of months, we're into a reasonably flat environment, flat to down environment, and therefore trade accordingly. Now, what else is going on? Well, there's some technical aspects to the market right now, which are quite interesting. I think that the asset markets generally are incredibly optimistic, which is not a problem. Most people are quite comfortable with that, and volatility remains at a relatively low level. However, behind the scenes, there's some crazy things going on in terms of market breadth. I think the S&P is rising these days with only something like 5% of stocks hitting new highs and something like 95% of stocks not hitting new highs, which is all a bit crazy and a bit too low. So again, it's all those big caps that are getting involved again, right? So there's some interesting market internals happening. All of this points to the basic message that we need to be careful, we need to be cautious, and maybe there's going to be a consolidation in the stock markets in the US. I don't think that necessarily will feed through to either the European or the Asian markets unless, and here's the unless the dollar falls, right? If the dollar falls and those currencies start to strengthen again, as we've been seeing, maybe it's time for a turn in the euro, maybe it's time for a turn in dollar yen. If those things do start to happen, then obviously those stock markets will struggle as well too, just on a parity basis in terms of where the US market is. So they tend to act together once you take account of the relative currency effects. So yeah, look, my basic thesis right now is to be a little careful on the markets for the next 5 months. The Asian markets, not the Asian markets, I mean the American stock market's looking a little overdone, I think so, and supply is creeping in. That's the core message I've got. Now, the other core message I also have as well too is just to reinforce and to once again reinforce this fundamental message from the Fed. I can't stress this enough, guys. You absolutely have to get this. Go read the last two transcripts of Powell's speeches for the last two Fed meetings, right? He is really clear about this, and often a lot of the market commentators forget what he's been saying. Okay, he will not act until he sees progress on unemployment, and especially progress on diversity in unemployment as well too, right? He will not move rates no matter what happens. Okay, so inflation could be 7%. He still won't go if unemployment hasn't caught up. Okay, it's a really key, important message, right? You've got to get a handle on the fact the Fed's job is not just to control inflation; it's also to manage the level of unemployment. And they still have a huge number of unemployed people in the States, as there are around the world as a result of the pandemic. They've got to get back to work again. If those numbers start to run very quickly, and the trend is very firmly for that downward track, a little bit more aggressive than what we're seeing at the moment. We need to see a substantial pickup in employment, which gets us towards those figures he's talking about. Then the Fed will start thinking about raising interest rates without actually doing it. Okay, but this is a very clear message. Rates aren't going anywhere in the front end of the US curve, which then means at some point that the long end rates, which have been rising quite rapidly recently, will have to stop rising, because you can't have a super steep yield curve. At this stage, the only time you have a super steep yield curve is in times of incredible uncertainty or war. We're not in those situations. So consequently, my belief is that I think that there's probably this move in rates is, whilst not overdone, is probably getting towards the end of the end of its gig, right? Within 20 basis points of the end of the gig, somehow or other, right? And if the rates do keep on rising, then the stock market will inevitably notice that, and we'll see some crazy things happening. So I think that's the key message I've got on a reflective Easter weekend, Paul. Cautious in the US stock market and what that's going to mean for all of the currency pairs around the world, and also don't fight the Fed.
Julian, do you think it's fair to say that the US stock market's now just on watch until we see a sell? There's sort of an inevitable feeling that at some stage we are going to see one, and it's just a matter of it's on watch until we see it?
Yeah, look, every year the market corrects, right? There's always a time during the year we can buy the stock market cheaper than where it was. And maybe this is the time, maybe it just goes sideways, Paul. I think I'm putting it on watch for sure, but I think it's already been done. The ripples of the hedge fund liquidation we saw last week, over the course of the last 2 weeks, I think, apart from market practitioners who are close to it, has gone completely unnoticed by everybody. Not if you own Viacom or Palantir shares, you certainly have felt the pain there. But I do worry that was one of the early warning signs that something odd is going to happen.
Julian, can you give us a quick summary of what actually did happen?
Yeah, so look, there was a hedge fund who was levered about between 5 or 10 times its market capital. They managed to get that leverage by going to a lot of the major banks on the street and asking them to do stock swaps rather than actually own the stocks themselves. Because if you do a stock swap, which is a derivative transaction, you have to put up less margin. And in putting up less margin, that enables them to lever themselves, because they can use the money to do the money they've got to go and do it with somebody else as well too, right? The money that's left to go, and you can lever yourself up to 5 or 10 times, right? So what happened is, as the markets have risen over the course of the last 18 months, he has that hedge fund, and that hedge fund principal, Bill Huang, I think, has more and more significant positions on in a smaller and smaller number of stocks. And when it came time that a couple of the major banks said, I think we need a bit more collateral here, he didn't have it, and therefore that was considered, as the old saying goes, that was a margin call. Nothing ever changes in life, right? A little bit of over leverage. I remember Warren Buffett saying the 3 things that can catch an investor out are liquor, ladies, and leverage. So my wife had a slightly more flowery description of it when I told her that, but it's a true expression, I think, for in this case it certainly applies, right? The guy was doing crazy things and he got found out, and when you try and liquidate those positions, it creates incredible ripples in the market, incredible violence, and more earthquakes rather than ripples, I would say.
So it's fair to say, Julian, that if we had one organisation doing it, we've probably got a bunch of organisations doing it, and the banks right now are going to be a bit worried and tightening up on collateral a little bit on all these positions.
Well, what's the first thing you're going to do when you've been once bitten, right? You're going to go around all the other hedge fund positions that you've got who have been doing similar trades with you and say, well, how much leverage do you guys have on? And by the way, we need to double your collateral. We need that right now, please. And you've got 2 days to comply, right? And so or you reduce your positions.
Right. And so if the banks, how much was the loss on this? Did they lost 50 billion?
I think the banks, they aren't talking about how much money they've lost, but I believe that some of the major money center banks are down $1 billion or $1.5 billion. I don't think Morgan Stanley and Goldman Sachs were, because they got in first, but there's some other banks out there which have lost a lot of money.
Okay, cheers for that, Julian. Always interesting to get the macro overview of what's happening out there overall. While macro overviews help us a lot to understand what's happening in the market, fundamentals drive direction on individual